Hello and welcome to our latest Insider interview. I'm Kyle Caldwell, and today in the studio I have with me Nick Shenton, co-fund manager of the Artemis Income Fund. Nick, thanks for coming in today.
Kyle, it's great to be here. Thanks for having me.
So Nick, over the past 5 years, the fund is top quartile in its sector, which is the Investment Association's UK equity income sector. So what have been the key performance drivers?
I'd say two things, really. Stocks. The companies we invest in, shares have gone up. So that's been helpful, obviously. That's what we do. It's our bread and butter. But the second thing that we think is really important is the portfolio, the fund, has been able to transition between two radically different environments with a curveball, if that's not mixing metaphors, in between a COVID. So we had quantitative easing when interest rates were very low. Then we had COVID, and now we've got inflation. Very, very different environments. But the fund has been able to navigate that through being diversified and through really thinking about the investment backdrop. It's not good enough to say when the going is good, oh yes, we're doing well. And then when it's not, to say, oh, but the markets are being unfair. We've just got to make money in different environments, and we've done that.
So the fund, it's aiming to obviously grow its dividend, beat the market in total return terms, and also have a market-beating yield. So how do you put all that together?
Oh yeah, and let's also say we've got to do it in a cleaner way than the market on average from an ESG perspective. So not too much to ask. We think about it really simply. We're simple folks. Find you've got to go through a lot of complexity to get to simplicity, and that's when you're on something. And so we look for around a 4% dividend yield growing at 5%. That's what we call the Holy Grail. And if we can deliver that, we think that's a really attractive investment proposition, regardless of where you invest. We think that stacks up really well versus global equities. We think it stacks up well versus different asset classes. And compounding at 9%, which is what the fund has done net of fees, give or take, over 24 years, means that you go from £1,000 invested at inception being worth over £7,500 now. So we think if we do that, and we've got the process behind it, then we'll compound people's capital. And you are right. We think about this as wealth creation. We think about this as total returns. We invest, and certainly Emma, my wife, and I invest all our spare pennies in the fund. That's what we're looking for.
The UK stock market, it's been unloved for several years now. So what needs to happen for that to change? What needs to happen for fund flows to turn positive once again for UK equity funds?
Yeah, it's a really, really fair point. But here's the thing about financial markets. Trees don't grow to the sky. And by that, what I mean is valuations only go so far. And at some point, capital flows from more expensive businesses into cheaper ones because the prospective returns are better. Yes, the UK's faced a lot of headwinds. Yes, it's been unloved. We still think there's some outstanding businesses here. The reality of what it will take to change that is really a different perception, and that perception will come from international investors. So there's a couple of things we see that we think are really interesting. You're right, we see flows away from active management to passives, and that's understandable. Passives and index funds and ETFs. It's incumbent on us to create value, not just by tracking an index. It's about stock picking and risk management. That's what we've got to do. So there's been structural pressures there, and we've seen capital flow overseas. But these two very interesting things are happening. Firstly, we're seeing that capital come back. So the money that's been leaving the UK, going to the US, we are seeing US investors show up in the UK, and they're showing up in size because they can see value, we think. And when capital, who we respect a lot, and Fidelity and Causeway and WCM and all these big US businesses, when they show up in the UK, they move share prices, and they are showing up. And you can see that in Sage, you can see it in Next, where capital have just taken 5% of the company in a few months. And that, to us, is a signal of value. And then the companies themselves are saying, well, if you won't buy our shares, UK public, we'll buy them ourselves. And over 60% of the portfolio by value has bought back shares in the past year. And we're on that ticket. If we're patient shareholders, we think we'll end up owning the businesses through the golden share because all the other shares will have been bought back. So something has to change. But the interesting thing is it is changing. We can see it in the market. We can see and feel it.
One sector that's benefited from money leaving the UK is global equity income funds. So could you make the case for investors to return and to pick a UK equity income fund that you like the one you manage over going global?
Well, they both have a role in portfolios, we would say. Something that we slightly scratch our heads on from a first principles perspective is, surely if you're saving for retirement, you want to be saving in the currency that you're going to retire in. And the US is an amazing country, an amazing wealth creating society. But maybe it's a bit risky to be putting all of your assets effectively into US dollars when you've got two, frankly, inflationist presidential candidates. So that we don't quite understand necessarily. But of course, it does make sense to diversify and to invest overseas. What we would say currently is we think there's a lot of value in the UK that's actually been created by that trend. As people have sold the UK in a price-insensitive manner to go global, then that's created an opportunity in the UK because valuations are cheaper. And valuations are cheaper in the UK versus pretty much every other stock market. And how does that manifest? Well, you get a higher dividend yield. So your dividend yield is close to 4 in the UK, which is significantly in excess of what you get investing globally. But as we say, we think it makes sense to have both strategies. Just to us, the value looks more apparent in the UK. And if we may as well, there's some outstanding businesses in the US, but going overseas is actually largely going to the US, and within the US, it's largely going to tech.
You mentioned earlier that the fund aims for around 5% dividend growth per year. So has that been achieved over the past decade?
Yeah, it's been a challenging 10 years because if you were to go back 10 years, there was probably over-distribution and there was disruption, and we were quite vocal on that companies needed to reinvest more. Where we are today is we think the competitive environment is the best it's been for probably 15 years. The type of businesses we invest in, and their dividend payout ratios are lower than they were 10 years ago. That's a good place to be. And then the second challenge has been COVID, which rebased things. So if you were to look from 2014 to 2019, the dividend actually grew at about 7%. But then it got rebased during COVID. And we actually worked with companies and said, don't pay dividends, build your liquidity, get through this intact. And so over the past decade, the dividend growth has actually been lower at around 3%. But we think the prospects are pretty good from here. It's very well covered by cash flow. And with companies buying back shares, you get growth from that too. Maybe one of the best examples is Tesco. It's around a 10% free cash flow yield. So you get a 4% dividend yield, and it's growing at 5% just from share buybacks. So we think the prospects are pretty good from here.
And as a fund, all of the income that's generated by the underlying investments, you return that to investors each year. So if there's less money coming in, then there'll be less dividends paid in a given year.
Yeah, but what we see also as the opportunity from here is this reduction in share count. So we're saying stick with us and your ownership of these companies will go up. And again, let's return to Tesco. Last year, we and our co-investors increased our ownership of Tesco by 5% without spending a penny. And that's from share buybacks. What that means over time is the dividends will go up. So the number of shares fall, the dividend per share goes up. And so that, as I say, is one of the reasons we feel pretty constructive about the outlook for dividends and dividend growth.
And in terms of sectors, are there any at the moment that particularly stand out for you that are increasing their dividends? Is the banking sector, for instance, an area that you're invested in? I think this year it's going to be a year-on-year increase for bank dividends.
Yes, it is, and it's also an area where we've been very closely engaged with the management teams. We are genuinely active investors. We are fortunate with our access to companies, but because of the scale of Artemis overall in the UK market, and we've got some very good fellow UK investors, we have good conversations with companies, and this point about share buybacks is one that we've really worked on with Lloyds and NatWest and Barclays. And we agree. Very simply, the banks had 10, 12 years of paying fines and building capital after the financial crisis. That's largely done. And now they have strong capital positions. They're very well regulated. We think they're very well run. And they have surplus capital. And the shares have been so cheap that they've been able to buy back large chunks of their stock. And that leads to increased value per share, we think. The really strange thing is that the share prices hadn't been reflecting that. So we were almost scratching our heads saying, why are share prices not going up more? Because when the share count goes down, the share price needs to go up. Otherwise, the value of the business is falling, which makes no sense. So banks, we think, are well placed, and they are quite key for dividends and dividend growth looking forward, we believe.
And you've already touched on the answer to my last question, because you've mentioned that yourself and your wife have investments in the funds.
Yeah.
Have you got anything further to add in terms of your skin in the game?
Yeah, we eat our own cooking. You'd never go to a restaurant where the chef wouldn't eat their own food. We think, why would you invest with a fund manager who doesn't invest in their own funds? Yeah, look, I'd say we're all in. We are partners at Artemis, Andy, Adrian and myself. We're very passionate about the business, about the culture, about what we do. We are very, very competitive people. So we care deeply about our investors and about producing the best returns for them. We have some investors who've been with us for over 20 years, and we take great pride in that. I think when we look back at our careers, maybe the thing we'd be most proud of is that people trusted us. That's the most valuable commodity, is trust, that people trust us with the future of their families, their savings. We take that very, very seriously. And then we invest alongside. So Emma and I, everything we have that is spare, that isn't in our home, goes into investing in the income fund.
Nick, thank you for your time today.
Thanks very much for having me, Kyle.
So that's it for our latest Insider interview. Hope you've enjoyed it. Let us know what you think. You can comment, like, and do hit that subscribe button for more future videos. And hopefully, I'll see you again next time.